Hey, Renter Retires, it's Adam Schrader here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Rent to Retirement. We are pleased today to be joined by Carrie Cook. She is the president of Ignite Funding, and we're going to dive in a little bit today. But Carrie, before we get started, I always like to ask people, how did you come to be in the real estate space? And, what was your first kind of experience in real estate?
All right. Well, coming into real estate, it was not the traditional sense. My first real estate venture was because of a divorce. Classic, right? You lose everything and you realize that's never going to happen to you again. So after that, I did purchase a townhome. And I realized very quickly that I could monetize my investment by moving out and renting it to somebody else. And that rental income not only paid for my mortgage on the townhome, but it also paid my rent on my apartment. And that's where it hit me. I'm like, wait a second. This is crazy. What if I multiplied this over and over and over again? So then I created the philosophy of 50% down and you kind of work from there. And that's how I accumulated my rental properties originally. And I started that. I actually got married when I was 18. So my introduction to real estate was very early. My first home I purchased at 18. And so, very quickly, I started to realize that real estate and the equity that was built within it was a strategy I would probably deploy for the long term. How I got into where I'm at right now, not usual. They actually were looking for somebody in the marketing department. The company at the time had no presence whatsoever on the web anywhere. And this was in 2005. And I kind of worked my way up through the system, learned everything there was to know about a whole different structure of real estate, but I already had the real estate investor mindset. So it was pretty easy for me to navigate through that. And slowly but surely, I took over all the departments and worked my way up to the top, lived through '08 and did it all.
Yeah, if you wouldn't mind just talking about you mentioned how you worked your way through it. What led you to not necessarily abandon, but change the strategy? Was there a specific event other than 2008 that led you there, or was it 2008, or what changed the strategy?
Yeah, I don't think my real estate strategy changed until I aged. And the older I got, the more I realized that I did not want to deal with tenants. I didn't even want to deal with the property management companies. And so I was looking for something that was a little more passive for me, although I still have a few rental properties, not going to lie. I have more in passive real estate than I do in what I would consider to be active real estate. And so working here and starting to run this company, I started to realize very quickly that I didn't need to do all the work. And I didn't need to outlay as much capital to do it. And so it was an interesting switch, but I think being in the business is really what transitioned that for me.
Carrie, and thank you so much for sharing your personal story and kind of as how things have evolved over time. That's really important. A lot of our audience is following this journey of they're usually newer to intermediate type of investors and we have some very experienced investors as well, that maybe have 50 to 100 doors plus, but the average person is probably 10 doors or under, or even
Mhm.
trying to get that first door under their belt. They're looking at real estate, they're buying asset classes, we're helping them choose the markets that make sense for them because maybe their local market doesn't make sense. Or they're busy professionals, they just want to invest in areas that offer the best returns. But this is buying physical assets. But there is this transition that we generally see where after people acquire the number of physical real estate assets that they want to own, whether that's, 5, whether that's 10, 20, whatever the case is, generally the common consensus is, hey, I love real estate. Like I'm still a believer, I get it, but I want to be more passive. And you mentioned that just a moment ago. I want to talk about Ignite Funding and like exactly what you guys do. I think it's a really unique option, like focusing on the more secured, more passive ways to invest in real estate.
Yeah.
That is still backed by a physical asset where you're like on the debt and the note side. Like that's a very interesting thing that not a lot of people have an understanding about the benefits of that, but also like how that can play an intricate role in their portfolio. I'm especially excited to talk to you because You guys make note and debt investing in real estate by secured real estate assets. You make that accessible to people where they don't actually have to be an accredited investor, and they can
Correct.
invest with a reasonable dollar amount. So this really is an option potentially for everyone, versus most of the note companies out there that require you to be an accredited investor and have very high requirements to invest. So I know I just rambled on for a long time. Tell us about
Okay. Let me break
Ignite.
that down.
Let's go. Tell us about Ignite funding and why we need to think about this for our investing portfolio.
Yes, I guess there's a transition in between my personal real estate journey I think I should probably talk to you about first. And that was before I went from rental to syndication to trust deed investing. That stop along the way taught me a very, very valuable lesson. And one of them happened to be a private REIT, REIT, Real Estate Investment Trust. And it was a pool of real estate investments that were managed by somebody. And that pool in '08 collapsed, and I lost my entire investment in that. And I thought, well, wait a second, I've never lost money in real estate. What's going on here? And, as I was transitioning into my role here, I started to realize I don't want to have a syndication. I want to deliver a product to individuals where they can invest in real estate for a low barrier to entry and actually it be collateralized by the real estate. So if Ignite Funding decides to just close up shop, you still have your investment. That to me, that mitigated risk personally was something I wanted to deliver to everyday Americans so that they could invest in real estate without having to depend on this subset of managers for their fate. Yes, the document says it's real estate, but really you never get to touch it. You don't get to feel it. You don't get to see what's happening with it. You don't know if it went into default. You don't know if they're collecting payments. You don't know those things. So Ignite Funding takes all of that myth away. You are picking the investment that you want to invest in. So we underwrite the investment and we originate it. We deliver it to our investors to view. They pick the investment they want to invest in, and then they are collateralized pro rata by the percentage of ownership in that investment. So they own it. They're on the recorded deed. They're on title. It's their investment. Now, does that take a little bit more work to do? Absolutely, it does, because you're talking about investors being specifically allocated to an investment. Therefore, each investment is unique to them. They're not signing one document and they're in everything. They're signing documents for each one of those investments to make sure that it is all titled and recorded correctly.
So they're investing in notes, right? And I don't want to cut Adam off here, but I do want to just break down what that is
Yes.
for the audience. But
yeah. So there's a couple things. It's referred to as a lot of different things: hard money lending, private lending, trust deed investments, promissory notes. There's really 4 components to every single investment that we have. One, they are recorded deeds of trust. That's recorded in the county in which the property is located. Second, the borrower is signing a promissory note, promising to pay a certain interest rate for a certain period of time and to pay you off. The third is you're receiving an insurance policy on that particular asset, whether that be general liability, property insurance. And I know some people are like, oh, that's not important. But when your asset burns down, you figure out how important it is. And then the fourth one is the title policy. You always want to make sure that we always want to make sure that you're in first lien position. So there's nothing that can encumber your asset. So those are the 4 things that you're receiving when you invest in what you're referring to as a note. Note is the simplest terminology to use, but I think many people do not understand all of the risk mitigation and the information that you are delivered and recorded on for that particular quote unquote note.
So people understand, whenever you buy a physical asset of real estate, you look at your rents, you look at your price, you look at, your capex, vacancy, all of that stuff. And then they, if they're transferring over to note investing, quote unquote, and any of those 4, how do you do due diligence on that? And does it differ based on which of the ones you're going into? And so how do they, whether it's whether they're investing with Ignite or they're going off on their own, I mean, they want to
Yeah.
be doing their due diligence. How do you do that?
Yeah. So your typical mortgage, a bank is going to first look at your credit. They're going to look at your ability to pay. They're going to look at those things. As an asset-based lender, which is what I would determine Ignite funding to be, we're going to focus the majority of our attention on the actual value of the asset as is. And we're going to really hone in on like you just said, the cap rates, all of that stuff, the tenants, if there are tenants, acquisition of land, what the intended use is, the development of the land, is the borrower capable of completing a project? What is their track record? What is their history? So we're really centrically focused. Probably 80% of our underwriting and origination is based on the value of the asset. We will go out and we'll get third-party valuations on it. And I know many people are like, oh, so you go get an appraisal? Well, actually, I don't like appraisals. We don't like appraisals here. And nothing against appraisers. Just want to put that out there. I don't have anything against it. But the reality is they don't know that asset, the intended use of that asset, the future use of that asset. They don't know the full story of it, right? They're taking comps. They put a number to it. I'm not comfortable telling our investors that it's a 40% loan to value when I know darn well it's 60. That just doesn't make any sense. So for us, we actually like to do broker price opinions. And we'll go out to the brokers who think they're going to sell the land now. They're going to give you a price that they can actually sell it at now. And so it varies a little bit there. Plus, we're also licensed. So we're able to evaluate the value of property ourselves. We choose not to. We choose to get third party involved in that, but we obviously have our own internal analysis that we're doing as well. So asset first, value of asset, so we can determine what we're willing to lend on it. Then we do really hone in on the borrower's abilities, their history, their track record, their diversification in different product type. And then we'll run their credit. Then we'll look at, have they paid before, et cetera. Because when you're going to take a property back through foreclosure, you're not going after the borrower, you're going after the asset, right? You're going after getting that property back. So that's what we focus the vast majority of our attention on. Want to earn monthly income without being a landlord? At Ignite Funding, we fund commercial real estate loans and you become the bank. That means you earn interest every month backed by real property. No tenants, no toilets. Just passive income and predictable returns. Call Ignite Funding at 702-739-9053. That's 702-739-9053. Let's put your money to work.
Thanks for that rundown, Carrie. I have a list of questions I think that will just add clarity for myself and for the audience that I want to run through in a kind of rapid fire manner. I do want to mention, based on you had mentioned previously about your experience in syndications, and I just want to take a moment to say, like, I'm 100% there with you. I invested significantly in syndications over the past 3 to 5 years, just as we had excess capital we wanted to place somewhere. And we were still bought physical assets every single year, as we still do this year. We've never stopped investing in actual real estate, but this is a piece of our portfolio where it's like, hey, we don't want to own, thousands of single family doors. Like, we do want to have a diversified portfolio in these areas as well. But I've also lost significant capital, in some cases, all of my capital, in multiple syndications. I have one syndication I invested significantly in, and it's been a 4-year bankruptcy on it. It's like, the point being, if you're looking to, when people ask about syndications now, and I think a lot of people are also bleeding because there's been a lot of a struggle in the multifamily space, especially over the past few years with, debt becoming due again and those term loans and the rates skyrocketing, ruining deals. But I always tell people now my philosophy has completely changed. Like, if you're looking for a passive way to invest money into something like notes and diversified notes, that is the best way you can invest. Do not put your money in a syndication whatsoever, because to your point, you mentioned this, which is, I think a lot of people don't understand. You are solely reliant on the operator and the project itself. The operator has to be operating with integrity and doing, like, he has to perform, and also the asset, right, needs to perform. Otherwise, and you have no control and a lot of risk there. So investing in something like this is I think significantly less risk. Let me get off my tangent. Let me go through a few series of questions here.
Okay.
Are they investing, for the investor? Is it a diversified portfolio? Are they investing as in a single property? How
Yeah.
does that structure?
I feel like this is everything I did wrong. I've learned not to repeat, right? And so same with syndications. I went away from syndications. I went into trusted investing or note investing, and similar scenario of what you're kind of, I believe, referencing here from the question side of things. So diversification. I started in this business in 2005. I was in this business in 2008. We had our entire portfolio in Las Vegas. I couldn't give away land. So I will tell you, I learned from that. I learned from that experience, and we learned from those things. Although it took us 7 years to work through all of that, in 2011, after we came out of being asset managers, we went back to being lenders in 2011. I completely changed that philosophy. Our diversification is in, right now, we're in 13 different states, excuse me. That goes up and down. It accordions in and out. And we always were diversified in acquisition, development, construction of both residential and commercial. We now do industrial. We're in senior living. We've been known to do a few apartments. We are not a one-trick pony. We learned our lessons, supply and demand. Everything has to do with supply and demand. And the location is not as important to us as what the demand is in that particular segment, whether it be, a tertiary market, whether it be big city, small city, urban, whatever it happens to be. We really had to expand beyond. We stay on the West Coast, but we had to expand beyond that. Here's why. Because when investors come to us, since our barrier to entry is as low as $10,000 per investment, that $10,000, we want clients to diversify over 10 different investments. We want them to be in with different borrowers, different locations, different asset classes, so that if we're the one-stop shop for their real estate portfolio, we know that it's diversified. So we're basically running it, like a fund, but yet you have direct access to your investment. So that's the difference between us.
Cool. Yep. Diversification is key, not only across different locations, different asset classes. And so that answers my question. Definitely. That would be the high risk scenario. Similar to syndication is if all your money is invested in one deal, which is not the case.
Yep.
Diversified. Cool. You mentioned first lien position. So that's really important, meaning there's no senior debt. That's also a big thing to be concerned about, because, if you're in second or third in line, it's like there better be enough equity there. So first position is huge. Diversification is huge. What is the average return profile? You already mentioned, another question was, what is a minimum investment? That's $10,000. They do not need to be accredited, which in most cases, other options we've seen, they do. This is an option that, allows people with an extra 10K or whatever you want to invest. And I certainly appreciate that and make it more accessible for the average person. What is the timeline that if they're diversified across multiple projects, what is the average timeline that someone is tying up their capital in this type of investment? Like, in other words, what's the liquidity of it?
Yeah. So the liquidity side of it, it's not a liquid investment. But as far as our duration of time, most all of our loans are written for a 9-month duration with an optional 9-month extension. So we always communicate and educate to clients 18 months is what you're going to be in. But if you look at our portfolio as a whole, and we put all of this stuff on our website, by the way, we're very I run this like a public company. So you can go look for this information. We update it every single quarter, but we have funded $2.2 billion. If you look at our entire portfolio, the average is 10.27% that the investor is earning. That means that the investments are about 10 to 12 months on average. So although it's 9 and 9, and we definitely educate clients, be prepared to not have access to your funds for 18 months, the average is 10 months, because we're not cheap financing, right? Our goal is to get the borrowers to have us stop here. The borrowers stop for a short period of time, and then they move on. They refinance, they sell, they do whatever they're going to do with that asset. We are short-term lending. We're not long-term stop along the way.
Yeah, perfect. So I think we covered the majority of these items. So did you say average, just for clarification, average return profile or maybe you didn't mention that. What's a typical return that someone could expect if they're investing for 9 to 18 months?
Yeah. So 10 to 12% is what our investments are offered as. Now, they have to go 12 months in order to get, 10 to 12%. So on average, like I said, the entire duration since 2011, 10.27%.
Okay, cool. And I'll stop here and turn it back over to Adam. I know he's got a list of questions, but
Okay.
when I look at lending or investing in anything, there's a lot of things that are really important to understand that people should evaluate on, like, is this the right investment for me? First is, how much money do I need to invest in this? What's the minimum requirement? And is this, based on that, like, does this fit my investment profile based on the amount? Second, is it secured? If it's not, I wouldn't even consider it at all.
Yeah.
So clearly this is secured. Is it diversified? Am I investing in a single asset? That's different when you're buying a single family house, because that's a physical asset that you have 100% ownership of, versus, like a syndication or any individual deal. If you're invested on a lending capacity, if you're invested in a single deal, that can be highly risky. So is it diversified? What is the liquidity of it? And people don't appreciate this so much, because if you are tying your money up for a longer period of time, you would anticipate earning a higher return, because you don't have access to that. It's less liquid. Same concept applies to bonds, unless you have, the inverse curve that we're dealing with now. But in general, when you tie your money up longer, it should be earning a higher return. So having more liquid access to your capital is certainly more important, because that allows you to recycle it again, right? And recycle that return profile. And then, of course, like, what is the average return? So when you're saying 10 to 12% for investing for under a year, that is diversified and secured, I think that's extremely safe, attractive, and reasonable. And you have the option in the additional caveat, as you can invest with $10,000. So it's not this, you have to be accredited. You have to put in $50,000 or $100,000 into this one thing. You can start with $10,000, see if it works, and then continue to scale if you want. So I just wanted to break down my thought process on this for everyone, because obviously that's why we have you on here, Carrie, is because this is a really unique and I think exciting option that would benefit a lot of our listeners. So anything to add to that?
I think you've pretty much covered it. The risk ends up being the fact that, the borrower may not make their payment. But probably the most unique factor about Ignite funding is that we originate our loans, we service our loans internally, and we collect on them. So anything that we underwrite and we offer to our investors, we stand behind. You're not going to find another group out there like that. They usually will use a third party for, loan servicing. They'll use a third party for collection. We don't do that. We want the client's journey with us to be all encapsulated. We will control that entire situation and help them through that process. That's what truly passive real estate investing is.
I love that. One more thing for you real quick. How do you underwrite on the lending side? You're underwriting the deal, it sounds like. Tell us about your criteria there. Like, how do people feel safe that you're a strict, you talked a little bit about, like, the valuation and not relying solely on appraisals and things like that, but how do you ensure that you're correctly underwriting a deal to protect investors' capital?
Couple things. We talked about 2008. I think it's important to go back to that. I think there's so many lessons that were learned from there. And the individual that I was working with to take back the assets, that same individual is my director of underwriting. We have been together for over 15 years now. And his mindset is all about kind of that loan to own. If you're going to loan on something, you have to be willing to own it. And our review and our process and our evaluation that we do, yes, there's stuff that goes on behind the scenes, and we're obviously real estate professionals and educated in that field and what to look for and all of that. There's, decades of experience there. But there's also the psychology of it. And I think a lot of people forget about that. He has walked every single project that we put out to our investors. So we're not the Google Earth people. We like to go see and count the cars and make sure, if we're doing commercial, we go there. We physically go there and check
on your ground.
out.
That's what it's about.
And so, it has to be that way. That's why we're primarily in the West Coast, because, I got to be able to fly there and get home the same day, or I'm not going. So it has to be stuff that we can monitor, and not just before we lend on it. We actually visit all of our properties every quarter. And so we're always on the road. We're always out there making sure that things are getting taken care of and done and moving forward and that sort of thing. So we're very hands-on. All of our borrowers come to us. I have never, ever marketed for a borrower, ever. And the reason being is because we have a track record of actually being able to underwrite with the mindset of a developer. So we think like them, right? We're not thinking about how much money we're going to make on originating the loan. We're thinking about we want a long-term borrower for 10 years. So we also get to know our borrowers. So I visit our borrowers every single year. I break down their financials, and our investors get the opportunity to get the tax returns of our borrowers. This is required of us in the state of Nevada. They get a credit report from our borrowers. They get tax returns of our borrowers. They get their financial ability to make payments. They get a history of their track record. They get that information to be able to evaluate, like, is this a borrower I want to stand behind, not just the asset? Because that's important. We're not here to take back assets. Our goal is to move that borrower forward, keep them financially sound in their endeavors to build their business while making sure that they pay the interest payments to our investors. So we're not gougers.
I would imagine you have a lot of repeat clients as well that you're building rapport and a track record with, both on the investor side, but more importantly, actually on the borrower side, right? Because if you build a good relationship, you have a track record, like, that makes me feel more comfortable. Do you have any idea percentage of how many deals have to be required or acquired back or foreclosed on, or is there a percentage? Is it?
Of course I do. I know every bit of it. Because when a loan does go into default, and a technical default is when the borrower doesn't make a payment. So borrowers' payments are due on the 1st of the month. By the 10th of the month, that's when it becomes late. Between the 10th and the 5th of the month, my son refers to me as a loan shark, jokingly, right? But not really. When it comes to borrowers not making payments, that's when Carrie gets involved. And although I may seem very pleasant right now, I am not pleasant when it comes to my investors' capital and protecting it. I'm not pleasant at all. And matter of fact, Pat always says, well, do you want me to talk to Carrie about it? And usually the payment will come in. And I don't think I'm that scary, but I don't mess around when it comes to stuff like that. So, defaults are fun. But again, all this on our website again, but I will tell you what our track record looks like. We've had a 3% default on $2.2 billion. Of that, we've had a 0.29% loss of capital since 2011.
Man. So that was a baseball bat I saw behind you earlier for the kneecap.
Yes.
When people talk about investing in real estate, especially the like single family and that, there's different risk profiles, right? Like there's people who want to do the burrs who are gonna, buy in maybe lower areas, but they think they can add a lot of value. There's people who buy more like turnkey, and so they're safer and all of that. When it comes to this kind of funding, are there like, I guess, danger levels that people are going into, or is it all of your deals are roughly the same, or, what is there a structure and like risk level that people can go into?
Yeah. So probably the easiest way to explain this is loan to value. So if it's $1 million loan, our threshold is somewhere between 60 and 70% loan to value. So I'm only going to lend 600 to 700,000. I'm always going to keep a very big equity cushion in there. Always will do that. Now that doesn't mean that the borrower may not go out and get an equity partner. I don't really care about that, because if I foreclose, what happens to the equity partner? Bye-bye. Right? So that doesn't matter to me. But from an investor standpoint, I got to make sure that there's that equity cushion in there. So 60 to 70% loan to value. It doesn't matter if it's acquisition, development, or construction of residential or commercial, same rules apply. So that's probably the one thing you really want to hone in on, is just making sure that equity's there.
And that's current value, right? That's not a future proposed after repair. That's like true equity
right now.
Their first position, where Carrie's coming out with a baseball bat if they're missing that payment by the 5th. So
yes.
No, good stuff. This is great.
Yeah. And something important about that loan to value, loan to value at the time of as is, during that 9 to 18 month duration, they're actually reducing the loan to value.
They're improving
because they're adding value to it. Yes. So that as is, when you're looking at a risk portfolio or risk analysis, you need to consider that as well, depending upon the type of asset.
I mean, when we discussed this previously, it's almost like, it's not like you want the borrowers to default because that's just a pain in the neck.
Yeah.
But sometimes it's to your advantage, actually, right? Because you acquire
Sure.
an asset that's worth more than you lent on it. So, depending on the waterfall debt structure, but yeah, I mean that's a benefit of this as well from a risk standpoint. I just think this is fascinating, investing in notes and debt, and for people that haven't explored this is something that I think could be in your arsenal for life, right? As a way to be a lender, to be diversified, to facilitate that through an organization that has a process versus you yourself just lending to John Doe down the street or lending on one particular deal, right? This is a much better route to go, and you can participate with a relatively low dollar amount to just get your feet wet and start to understand it. If you don't have that money saved up for the down payment of your next investment property, and it's going to be, a year or whatever, this is a great way to earn additional capital versus keeping your money in a CD or a high interest savings account, right? Like this is just, I think, things to think about that everyone can benefit from. So Adam, I don't know if you have any other last minute questions for Carrie, but let's definitely tell the audience on how they can reach out.
Yeah, well, I think Zach, you covered all my questions with the rapid fire there. So there's going to be a link in the show notes, whether it's on YouTube or it'll be down in the comments. If you're listening to this on just audio, it'll obviously be in the show notes on whatever podcast platform you use. Again, Carrie is the president of Ignite Funding. Go check them out and see if it's the right fit for you. Like Zach said, accredited or not, it's just a $10,000 initial investment or more if you want to go that route. But again, go check it out in the show notes. Carrie, really appreciate you joining us today. To everyone else, really appreciate you spending the time educating yourself on a new type of investing. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.